everybody.
Sean and Kelly here with Price and Price Group of eXp Realty. So today we are going to do a very special market report.
It's going to be long.
Yeah, it's going to be long. What are we talking about?
Today we're talking about the concern and fear that turns into panic. Panic causes analysis. I like to say analysis paralysis.
What are they afraid of?
They're afraid that the house prices are going to go down.
That's
They're
right.
afraid of depreciation in the market, and it's made people stop,
Yes.
not want to get into it.
Yep.
Sellers, even if they would want to sell, they don't want to because they feel like they're not going to get what they either could have gotten last year, for sure, or might be able to get in 6 months to a year.
Yeah, so this is a really, really important video. We have a lot of clients that we have been speaking to that there's an opportunity in the market right now. A lot of people are making decisions that are not necessarily beneficial for themselves, and we're going to go into all the details as to why. So this is going to be a long video. Bear with us. We are doing this as a PowerPoint, and we're doing this interview-wise, so we're going to have some
I'm great at interviews.
flubs.
Also, I've never actually managed a PowerPoint
Yep,
before,
and
so
I'm
if
gonna
you
have to
see
hit
it
her.
hit me, that means I need to change the slide. It's going to be fine.
So this is going to be fun, but it's going to be very, very important. And we take no credit for the statistics we're about to show. This is from, I came back from a seminar, and the stats and the graphs that we're going to go over from Keeping Current Matters, and this was a Tom Ferry seminar, so we want to give the proper credit there. But this is really, again, I keep saying this is really important. So we've got to dive into this, and please pay attention.
Yeah.
Pay attention to these statistics because statistics run and should rule when emotion is going crazy.
Right.
So,
Yes.
all right. Okay, so let's get to the PowerPoint, and here we go. I'm going to smack you.
Do it.
Okay, so as Kelly said, concerns lead to fear. This is the progression of how things work. So people start getting concerned. Fear turns into panic, and once they have that panic, that causes paralysis, which Kelly likes to refer to this as
Analysis paralysis.
Yeah. And what do you mean by that?
Well, as I went into when we first started this, it's basically you get so wrapped up in the analyzing every little fact with nervousness and anticipation of typically the worst because of what we hear in the media and whatever, and it's this vicious cycle that really makes a lot of people just stop and they don't want to do anything because they just don't know what to do.
Yeah.
They're really so confused, even when they feel like they're not, even when they say, no, I understand, they said this here and they said this and look at what I see, and they think they understand, but they still don't know what to do about it, and that's a huge indicator of you really don't understand everything there is to understand.
And then you get frozen.
You
just
do.
get frozen.
You freeze.
Yep. Okay.
Like this. Like that deer.
Okay, so we have a lot of buyers that are sitting on the sidelines, and I'm telling you over and over again, we're waiting for the market to crash. And a recent survey showed that 1 in 4 still believe that prices will depreciate in the next 12 months.
Yeah.
Yep.
Okay, so fear number 1, home prices are going to crash, as you said. So let's talk about over-the-top forecasts for the end of 2022.
Okay, yeah, because this is one of the reasons that people are afraid of markets crashing.
Yes.
All right, so headlines were all over the place, and I've done some videos on breaking down the statistical inaccuracies of some of these headlines. We've had clients sending us these articles, but this is just an example. You can see 20% home price decline. They put these things in the headline because it creates fear, and it gets clicks, and it gets business. But let's dive into number one, let's dive into why they were saying this. So you can see that these are the seasonal trends for what happens with inventory in the market on average throughout the year. And this is also nationwide. This is not here in Virginia, but we do tend to generally follow the same tendency.
Yeah.
So you can see that January through May, we have increases in inventory. And you can see the blue, light blue, and gray lines. That's 2017, 18, and 19. So you can see that we have this increase in inventory. And then starting in May, going into the late summer months, we see inventory starting to go down. Okay, so those are the typical trends. Well, in 2022, remember the interest rates went up right here in March is where they started going up. So in 2022, when we hit that May point where inventory typically goes down, from May to June, inventory went up. So that one 30-day aberration, the experts all of a sudden started saying that sellers are panicking, they're flooding the market with inventory. Inventory is going up, inventory rates are at levels they've never been, home prices are going to crash, and they predicted this trajectory of going up. And that was going to be the driving force between bringing prices down.
All right, great. So now let's see how those headlines impacted the market.
Okay.
The actual market.
Yeah, the actual market.
Okay.
All right, so it created that fear that we're talking about. This consumer survey said that consumer confidence was 37% of those that were surveyed believed that housing prices were going to drop, and this was in December 2022. 37% of people believed that house prices were going to drop in the next 12 months. Another survey showed that right around January 2023, it was higher than it was when the pandemic came in, and it was higher than right after the great financial crisis. People believed that prices were going to drop. Now you can see in June that actually came down a little bit, so it was right around that 25%. So that's where we get the quarter of people. But still, a lot of people believe that house prices are going to drop, and that's what these headlines do. They create that fear, which creates that panic, which creates the paralysis analysis.
That's correct.
And again, the media believed that people were going to panic, put their homes on the market, inventory was going to go up. If inventory and supply outweighs demand, then prices have to come down.
And I think a lot of what they weren't anticipating, which I have no idea why, because we as realtors in the market, this was the first thing we said, right? It's like, wait a minute, what are they talking about? All of the people who bought homes in 21, 22 for these really low interest rates were like, why are they going to put their houses on the market now? There's no way they're going to trade that 2 and 3% interest rate for, at that point, 5 and 6%. That's just the dumbest thing I feel like I'd ever heard.
That's exactly it. People that wanted to move up, why would you move up? People that wanted to move down, you'd be paying the same price for a smaller place than you would for. So sellers were backing out of the market. So
sellers were insanely backing out of the market.
So that's a really, really good point.
Yeah, thank you, Sean.
You're welcome.
Okay, so what actually happened to the home prices in 2022?
Funny you asked.
Let
me tell you.
I'm ready.
Okay, so again, this was the prediction that inventory was going to continue to climb. All right, well, let's see what actually happened.
Okay.
Inventory did exactly what Kelly just predicted. The sellers were not going on the market. So inventory was actually lower. It was down 21% year over year, December 22 versus December 2021.
Yeah.
Did the media come out and tell everybody this? No. Did media come out and tell everybody, hey, prices aren't going down? No.
No. I'd like you to take just a second, like a quick pause, and be like, what do you remember if you were in the market? What do you remember media saying?
I wish we had
then?
all the headlines, because I've seen people
that
do
would
that.
Be awesome.
Yeah. But yeah, the reality is inventory was 21% lower year over year than it was the year before. Okay. So what does that mean? Well, let's look at the average, 48-year average of seasonal price movement throughout the year. Okay. So like we said, inventory goes up, demand goes up as we enter into the spring months.
Yeah.
So you can see we have this slow increase that goes all the way up, and then about May it starts to trickle down. And then November, December, appreciation is not happening as quickly.
And this is a pretty standard trend across the U.S., right?
48-year average across the U.S. This is not even
just
our market.
Northern Virginia.
Yeah.
Okay.
Our market is different. Our market, we are in a bubble. We have a higher income per capita. Our market is different, but we're going with the national trends. And keep in mind, 0.1%, that does not mean prices are coming down. That just means that the prices aren't growing as quickly as they were in May. And I'm going to give you a very, very clear example of that here in just a few minutes. Okay, so what happened in 2022? Well, this is the average. The dark columns are the average.
This is the average rate of increase or decrease, right? So you're saying to go from 0.6 down to 0.4, it's not that it decreased. You're saying that the acceleration rate was
decreasing,
lower,
exactly,
but not a decrease. Gotcha.
Exactly. That's exactly. So, and that's the 48-year. The dark line is the 48-year trend from the previous graph. So this is what happened in 2022. Okay, the first 6 months of the year, we had a huge,
insane.
Yeah, it was ridiculous. So what happened in the second half of the year? There was a correction. Now remember, interest rates went up starting in March.
Right here, yeah.
Yep. So we started to see the normal seasonal trend, but then as we got into the later months, we saw a window. Now, if you go back and you look at our weekly market reports, you will see that window went into a slightly favorable buyer's market.
We were saying buyers, get out there now, do it.
Yes, and so a lot of you missed that. So anyway, so what does this mean?
A lot of them didn't though. Like we did have a lot of buyers. You know who you are.
Yeah, you
so
listen.
Proud.
Yes, and you got a great deal.
Yeah, you did.
So what does this graph mean? You see the negatives here. Does that mean that the prices were coming down? So let's look at an actual case study and see how this played out.
Okay.
All right, so we have a house, and we're just going to use an arbitrary house that started at $500,000 on January 1st of 2022. March, you can see this change in color here, is when the interest rates started going up. Okay, so that $500,000 house with those rates of appreciation that happened in 2022 that we showed you on the last graph, by June it was at $552,055. That's a 10% increase in value appreciation by June. Okay.
So you're saying they paid this $500K in January, and only 6 months later, that same house, had they decided to put it on the market for whatever reason, would have
sold for $552. Yes.
Wow, that's a good ROI, right?
Yep. Now, if you can click back up to the other chart,
the previous,
the one with the orange lines. Yep. So now, starting in July, we see that we actually got into negative appreciation, or a little bit of depreciation, because the market was correcting, okay, with the interest rates and with that high appreciation that happened. So we're going to see what happens there.
But let me interject the reality of that. The word you're using is depreciation. I'm gonna fight back on you a little bit on that terminology. The numbers say depreciation, but the actual thing that was happening there, if you lived it, was that sellers and some of their agents were still putting homes on the market for these really ridiculously high prices. Good point. Because back up here, they would almost be like, what can I get for it? And they would just throw it out there, and they were getting it. Okay, they were getting it, because these people that maybe would have been pre-approved at a normal interest rate for $500,000, suddenly at those crazy, insanely low interest rates during the pandemic, when they were trying to do all the things they were trying to do, throwing money out at everyone, they're like, wow, we can get $850,000. So when you spread that across the board, all of these sellers are like, what? Wait a minute, I can get this for my house? So I just want to say this wasn't actual depreciation on what the real numbers would have been. It's the correction you were talking about, and not a correction in the market, but a correction in
sellers' mindsets. And
do you remember? And I don't blame people taking what you can get, right? I mean, that's a good thing. So it wasn't wrong to do that, but let's really take a realistic idea of what was going on behind these numbers.
And the other thing behind that too is that's when the interest rates really started getting up above like high fives into the sixes. And so sellers were getting a little bit nervous, and they were actually offering buy downs. They were taking, they were more negotiable in that little bit of period where that correction was happening. Sellers were getting a little bit nervous.
Yeah.
And so there was a lot happening there until things kind of normalized.
Right.
So even with this, let's go back to that other slide. Nope.
I'm sorry.
So even with that, as prices started to make a little bit of a correction, or sellers made corrections on their sales prices, we came down in those areas. So by the end of December 2022, we were still at $530,000 for that same $500,000 house. Okay.
Right.
Now this is really, really, really important to understand. We're going to show you a graph of history since 1980, and it's going to help you understand what that means. When you're looking on the microcosm, the market does stair step. It does kind of go up and down. If you are, there's a saying in investing and in real estate that it's not timing the market, it's time in the market. Okay?
Not timing?
Not timing.
Like not getting in or out at the right time.
It's not like picking the right time.
But
it's
how long you stay in there.
Yes. So if you were brilliant enough that you knew 100% that you needed to buy in July of 2022 because prices were about to start coming down, or even December 2022 because that's when it was going to hit its rock bottom. Well, it didn't hit a rock bottom. It's still 6% higher.
But if you knew it back here, then like we want your name and number and contact info. We're going to send you monthly gifts for your magical insights on exactly what the market's going to do and when.
Because those people that are trying to time the market have been sitting out now for 2-3 years, and they're missing all of this appreciation. Even in that little microcosm, they still gained $30,000.
And those are really sad conversations. I know we had a client that we were working with at great length and deeply yesterday, and it was just, we were having these, I heard you on the phone having the talk, and it's like, if you had done it last year, like I was telling you, you know, now, and it's sad because they're seeing it, it was over $100,000 more just
for the same
last
house.
year, the same one, same neighborhood, same house, and that, like, Just listen to me.
So that's what happened in 2022. Okay, so that's where all this fear of panic came from. And then go back to the previous slide. So I can guarantee you that when this was happening, the media was hitting that again.
Yeah.
And they were hitting it hard.
Oh, you know they were.
Yeah. All right, so double click. Nope. Forward. Nope. That's perfect. Yep. One more. Okay.
I did it.
So what happened in 2023?
So what happened in the first half of this year, and then let's talk about what we see happening in the next half.
Okay. So January 2023, still a little bit of a decline, just as everything was still correcting.
And let me just point this out again, right? The dark gray is the 48-year average, right? This is the 48-year average.
Yep.
The orange is going to be 2022, our unicorn year.
Our unicorn year.
Okay, and then green, we're talking about this year, 2023. Okay,
that's exactly it.
Okay.
So negative appreciation in January, but then we started going back into positive appreciation, and we've seen that continue throughout the year. Now, here's what the media is twisting now.
Okay.
2022, February, 1.9% appreciation. The 48-year average is only 0.3%. February 2022 or 2023, in spite of interest rates, in spite of all the negative news, we were still at 0.2% appreciation. Go into March, 48-year average is 0.6. We were still at 1.3. So we're almost double, actually more than double, what the 48-year average is with regard to appreciation in 2023. But what the media hits is appreciation is down from the unicorn of 2022. So they're bringing up how much it appreciated last year and saying that we're not appreciating as much this year, indicating a market crash. When the fact of the matter is, it's still a strong market.
And we've talked before about how the media chooses their stories based on the negative news because that's what gets people anxious, and anxiety and stress levels makes them listen more because we naturally want to figure things out to try to save ourselves and analyze and figure out what to do to not have a problem. So that's why they focus on that.
And that's a really good point. So you have to look at the intention of your information source. Okay, so you look at the intention of the media, it's clicks, it's eyeballs, it's all of this stuff.
Right.
Look at the intention of Kelly and myself. We are realtors. And I know you're probably saying to yourself, yeah, of course you're saying this because you want to sell houses. Fact of the matter is, if the market does crash, we're going to sell a lot of houses anyway because there's going to be declining prices and we're going to have a whole other set of issues, but we will still sell houses. The fact is, we're giving you statistical analysis here so that you can make an educated decision, and you make a decision on what's right for you, but in our opinion, this is not the time to be sitting out.
Yeah, and we've lived a lot of years together. We've been married 24 years, and we've lived in a lot of houses, and we've made a lot of mistakes, and we've made a lot of non-mistakes.
Yes.
Thank you very much. So we have a lot of blood, sweat, and tears that's gone on into our knowledge as well.
That's right. That's right. Okay, so here we are. So what this is showing is that we have a decline or a depreciation of appreciation. So we're still going up in prices, but it's not going up as much. So the rate of appreciation has depreciated. Okay, and that's going to be important in a second.
Okay, you're going to go into that, right? Okay, very good.
All right, so click. All right, so this is what's happened from January of 2023. We were at 530, which was still, of course, 6% above that 500,000.
Okay, so this is where we left off on the other slide that looked similar, right?
Yep.
Okay.
And so then January we went down a little bit more.
Okay.
And then February, March, April, May, and now we're up to 552.
Oh, bang.
Yeah.
Bang.
Bang. So again, that house, January 1st, 2022 was $500,000. It is now it was in May, $552,000. It's probably closer to 565 now, just because it's continued to appreciate.
Okay, so we have people that are going to be looking at this and they're going to say, well, what if I bought in June for 552 and I haven't gotten all this appreciation? What would you say to those people?
I would say, again,
yeah, but you've only lived in it a year and you haven't lost any money, which is what the media would have you say.
And we tell you, if you can live in a house for 3 to 5 years, you're going to handle any of these market fluctuations. Right. But if you had that brilliance and you were right on and you bought in January of 2023 because you knew that was the smartest time to buy, because again, give us your number.
We're being a little facetious there, true, because that's
it's impossible
weird.
to do that.
But nothing is impossible, right? So
right.
If you really are one of those, we really do want to support you.
And you have some system that figure that out.
We really do.
Reach out to us.
We honor that. That would be.
And we're going to buy some houses together.
That would be amazing.
Okay, anyway, so that's where we are at this point, so that appreciation. So the key is to understand that deceleration of appreciation or a slowdown of appreciation, which is price increase, is not the same thing as depreciation. Depreciation is a loss of value. It's a $500,000 house that is now worth $400,000. That's 20% depreciation. Okay, so
it's kind of like this. It's kind of like, as you so rightly say, I only get better with age, right?
Of course.
I get better and better, but maybe like from you met me in my teens.
Yes.
So from my teens to 20, it was like this insane appreciation.
Yeah.
20s to 30s, again, super insane. That maybe by the time I hit my 60s, I'm still going to be appreciating, but you're saying maybe not
it might
slow down, right? But I'm never going to get what you're saying. I'm never going to depreciate in looks,
That's
smarts,
exactly what I'm
skills, or anything like that.
So Kelly is the example of what the real estate market will do over time.
I understand now.
Or another analogy might be if you're driving up a hill. And at the beginning of the hill, you're going really, really fast, but by the time you get to the top of the hill, you're going slower, but you're still going up the hill. You're not going up a hill.
I think people understand mine a little bit better.
I think yours is good. Okay.
I like the hill.
All right. So here's why this is important and why I went into the numbers of the $500,000 house. To show you, yes, things go up, they go down. Okay? It does happen. Let's look at what's happened since 1980. Interest rates in the 80s were in the double digits, like 15%. I've heard 18%.
Oh my gosh, yeah, I heard
ridiculous.
18%.
My mom bought her house in 1985 and had a 15% interest rate. So the interest rates were crazy. From 1980 till 2022, the average appreciation per year has been 4.92%. Nowhere in there has an entire year, turned in turned in actual depreciation where houses have lost value.
But wait.
Now, they've flattened. You can see like 1%, less than 1%.
But I'm seeing this.
We're going to get into that one. So.
You better watch out now.
I'm getting feisty. So the red, and I've talked about this on numerous videos.
Or orange, right? Is it more like a burnt orange?
We always have this argument over colors. Anyway, this not green.
Yes, the dip.
That was the great financial crisis, 2007, 8, 9, and 10.
Yeah.
Prices depreciated then. Why did the prices depreciate in that time frame? Because that great financial crisis was caused by the mortgage industry. It was caused by the real estate industry.
Predatory lending.
Yes. We have had multiple recessions. We've had multiple changes of presidents. We've had multiple wars, and prices have always gone up except for that window.
Right. So when they say, the big they say, we're headed for another, financial or housing market crisis and all of this, that was handled, that was taken care of. They identified what was going on with the lending things. They've got Dodd-Frank. There are so many different things that they've enacted, and I'm telling you,
it's a different world.
It's a whole different
ballgame. We're going to dive into that as we go through this. Yeah, it is completely different.
So that's why, ladies and gentlemen.
And that is the quote that we hear from the majority of these buyers. It's going to get back to 2008 prices. It's not going to happen.
It can't.
I mean, this shows historically. We cannot predict the future. We don't know what's going to happen. But if you look for historical verification, you do not have any verification that is going to happen.
Sometimes I feel like I can predict the future.
You always do. All right.
I'm just not right. If I'm not right immediately, I'm just not right yet.
Yes. So that was fear number one about prices going down. Now, I actually factor number one and all the different factors that played into that. So factor number two about prices going down, what's that going to be?
That is going to be foreclosure tsunami. Have you heard of that?
I hear it all the time.
I honestly only recently heard of this, was the foreclosure tsunami.
Yep. Yeah, the foreclosures are going up. So these are the points. Click the button. Watch this fancy thing. These are what everybody's saying as to why the foreclosure tsunami is coming.
Okay. The recession will cause unemployment to skyrocket.
Yep, that's the reason number one.
Let me think about that for a second. I don't see that yet. Okay.
Yep.
Highest mortgage debt in American history.
Yep, we're going to dive into that. Yeah.
Wow, trillion, right?
Yeah.
Okay, millions are leaving the forbearance program. I can't wait to hear you talk about that. And then foreclosures are up 187% over 2021.
That is proof that the foreclosure tsunami is coming, supposedly. Okay.
Yeah, I don't know about all this. Homeowners are not paying Mortgage.
I'm hearing that. I'm hearing it. I'm hearing it from buyers. Buyers are telling me that they're seeing it in the news.
But they're seeing it in the news, but you're not hearing your buyers saying we're not paying.
We're going to go into all. We're going to get rid of all these.
I'm ready.
rumors.
I'm ready to talk negative equity due to falling home. Well, we've kind of already dealt with that.
Everybody's upside down supposedly. That was an article that I received over last year talking about all the negative equity, and it's like I totally dispelled it. So we're going to get into that.
Insane in the membrane.
Yep.
Okay, let's go into recession will cause unemployment to skyrocket.
Yes. Click it. Okay, so the 75-year average rate of unemployment, 5.7%. During the financial crisis, it was 8.3%.
The financial crisis.
That's the 2007 to 2010.
It's not the pandemic.
Nope.
That's that big dip we saw in the,
Yep. Where are we at today?
3.5%.
So based on assuming that the unemployment statistics are consistent over what's been reported historically, we are almost at half of what the 75-year average is.
Okay.
So there are jobs, and in fact, we do know this. Employers are finding a hard time finding employees since the pandemic.
Right,
so
that's true.
Unemployment is not an issue. All right,
let's talk about the highest mortgage debt in American history.
There's a lot of mortgage debt.
$12 trillion.
You know why? Because people own homes, because there's a lot more people. Population has increased. If you look at the mortgage debt to income ratio, we are at 3.9% today. Look at the averages. 1980, it was 4.4%.
Yeah.
And look what it did before, 7.2% in 2007, right before the financial crisis. So it would have to almost double to get back to that level.
Right.
So
that's a good point. And let me try to give an analogy, because you know how I love those, right? So when we first started out, maybe we had 2 credit cards between the two of us, and maybe each of them only had, I think we had one with a $2,000 limit, one with a $2,500 limit, and in school and all that, we had like a lot of debt. We had, I think we got it with like $4,000 of the $4,500 allowance, right? Yep. Well, now let's just say we have a lot more debt, but we also have like
a lot more income.
A lot more income and a lot more cards with a lot more. I mean, we still keep our debt. Everybody will be very proud under the 30%, 10% thing. But I mean, there's a lot more of it. So someone could say, oh my gosh, you know, when you were just starting out, you were only $4,000 in debt.
Yeah.
And now you're what?
100,000.
Wait, factor in the house, you're like $2 million in debt. And it's like, what have we done? We've been failing this whole time, right? So it's sort of like that.
So in other words, the point on that is that people have disposable income. In spite of all the negative news, people do have disposable income. And this is mortgage debt is 3.9% of that.
So this is actually a good news. We've got more people out there of the age to own homes and more people able to own homes. I mean, there's so much more home ownership today.
And a lot of this has to do with the Dodd-Frank thing too, because they had that debt to income ratio. So all these things played in with each other. So there's no foreclosure becoming because of the high mortgage debt.
Okay. Millions are leaving the forbearance program. Talk to me about this.
I hear this over and over again. So there was a forbearance program during the pandemic where people could put off doing paying their mortgages. And the fear was when they left that forbearance program, those back payments on that mortgage was going to cause a lot of people to leave their houses and cause a foreclosure crisis. So let's look at where we are with that.
Okay.
All right. So in May of 2020, this is how many people were in the forbearance program. We are over here in June of 2023. 0.44% of all the people that took forbearances have left the forbearance program in June of 2023. Everybody is out of the forbearance program.
Have left it or are still in it?
Nope, they're coming out of it. Those are the people that are coming out. So because the time runs out. So as time has run out, more and more people have had to leave it.
So basically, all of these people
have already left.
And they're making their mortgage payments.
Yes.
Right. So if they had to leave this forbearance program by now, we would see a lot more inventory. Even if it was in the form of foreclosures, it would still be inventory on the market, and we're not seeing it because they're paying their mortgages.
Yep, they have left it and they're paying their mortgages.
And we talk to a lot of lenders all the time, and regularly kind of check in with them and ask, hey, are you guys seeing any foreclosures or people being delinquent? And they're just not.
Because we're looking for it. We want to see. We don't want to see them, but we have clients that are looking for it. So we are actively looking for them, and they're just not there.
Now that is the caveat to our area. We're not talking to many lenders outside of our area, so that's not a nationwide conversation.
But the stat is nationwide.
The stat is
so
nationwide. As I was saying, though, the stat itself, though, is nationwide.
All of these statistics are nationwide. Again, our area is much stronger than even what we're talking about here.
Yes, that's exactly what I was saying. So foreclosures are up 187% over 2021. So that means you just lied with what you just said.
I just lied. Do not click.
Okay.
Back when I was a chiropractic physician.
He's a retired chiropractor.
Yes.
That's why.
My wife was pregnant, and the swine flu was out. And I was watching the news, and not getting into natural health care versus this, that. We were always watching statistics to make the right healthcare decisions. Mm-hmm. And a report came on the news, and it said 90% of pregnant women infected with a swine flu are ending up in ICU. That scared me because she was pregnant. Well, when I dove into the study and I looked at it, 90% of pregnant women who had gone into the hospital with some kind of complication of the pregnancy and had coexistence of swine flu ended up in the ICU. And the actual number was like 500 women.
So the
nationwide.
Were only sick pregnant women. So not just like
with
women,
comorbidities,
and then
that also
pregnant
had
women,
swine flu,
and then the pregnant women who went into the emergency room, and then the ones that even if they went in for something else, they tested and showed positive for swine flu.
and ended up in and then they ended up in ICU.
Yeah.
So that fear, even from a very logical perspective, that fear hit me. So I had to dive in and look at the numbers. Okay, they manipulated numbers. With that happens over and over again. I've dispelled many articles with the same thing about negative equity. So let's look at how are they manipulating these numbers, because this is a headline that we've seen and the buyers are seeing and causing them to wait for these foreclosures. How are they manipulating this headline? Let's find out. Okay, 2021, we had 65,000 foreclosures.
Okay.
2022, which is when this article was written, they had 165,000 foreclosures. Okay. You're right, it was up 187%.
Right.
What was it back during the financial crisis? 1.7 million.
Wow.
What was it any time after the financial crisis? We are at the lowest levels of foreclosures.
Yeah.
But they
now,
don't.
not in 2021, because keep in mind that's when the government was dumping a lot of money on all of us with SBA loans and. That's exactly right. And
low foreclosure rate here, so they pick the smallest number possible, and then they say, you know what, it's blowing up, 187%. Yeah, I mean, it did go up, but it's nowhere near the average.
Right.
Okay? So there's not a foreclosure tsunami coming. Foreclosures are not increasing dramatically. Again, we don't see them in our market very often.
Yeah.
So just be realistic and look at the statistics on this.
Okay.
Okay. All right. What's our next one?
Oh, I'm sorry. Okay. Next, homeowners are not paying their mortgage.
That's horrible. That's got to cause foreclosures to happen.
And I'm sure they wouldn't be holding out and not telling us, these lenders that we work with all the time.
They wouldn't do that. Well, let's see what Freddie and Fannie say about this.
Come on, Uncle Fred and Auntie Franny.
June 2023.
Okay.
These are the number of mortgages that are at least 3 monthly payments behind. Okay.
Wow.
Look how that number's going down.
Wow.
It's less than 1%.
Okay, so you're saying these are the two main agencies that make mortgage loans. They buy them, right?
Yep. And even at the top of this graph, it was 1.1 and 1.2%. So 99% of people, even at the top of this graph, were still paying their mortgages.
In 2022.
Yep.
They were, and then we've done nothing but go down, which means fewer people are not paying, which means even more people are paying and being consistent with paying their mortgages.
Yep.
Okay, gotcha.
So
tell us about this.
According to Marina Walsh, VP of Industry Analysis from the MBA, the seasonally adjusted mortgage delinquency fell to its lowest level in the history of the survey since 1979. Wow. Resilient job market, we've discussed about. Homeowners are continuing to pay their mortgage payments.
Right.
So again,
it's
just a lie.
We have someone who's not in the media, but who does this for a living. She's the VP, right?
Yep.
And says, because of this amazing job market, whereas what did what did the talking heads?
The media.
The media, I just said that word too. Ding, 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 ding. The talking heads are trying to say that the unemployment rate is terrible and all of this, right? So if we were in media, we would probably
we might get canceled for this video.
Oh man.
That'd be cool. I've always wanted to get
canceled.
I
don't want to get canceled.
I don't want to get canceled.
It just feels like
I want to get deplatformed. No.
I feel like our teenagers cancel us a lot anyway. I've got all the canceling I need. Okay.
All right. So anyway, mortgage delinquencies are at the lowest they've ever been since they started recording this since 1979. It's a lie. People are paying their mortgages. Don't let that keep you out of the market.
Right.
All right.
Okay, lastly.
This is my favorite slide.
Is it really?
Yes.
This one?
This is ridiculous.
Is it because this one is the one highlighted in neon orange, or what do you like about
this slide. The next one we're about to talk about.
I'll print it for you if you want. Okay. Negative equity due to falling home prices. Let's go to Sean's favorite slide.
Last reason why the foreclosure tsunami is coming is negative equity. All right.
There we go.
Millions fewer homes in negative equity as compared, let's see, this is negative equity height of the great financial crisis compared to 2023. This was the great financial crisis, 16 million homes in negative equity. Why did everybody leave their home? Why did everybody let their house go into foreclosure? Why did this happen?
Predatory lending, they couldn't really afford it.
And there was negative equity. They had gotten all these loans where they had to refinance, and when they went to refinance, the house wasn't worth what it was when they bought it. So they were negative equity, they left the house.
That's true.
344,000 in 2023 have negative equity. And a lot of those are negative equity simply because, for example, a VA funded loan, when they fund that loan, if they do it at 100%, they fund in the closing costs. That house now has negative equity.
They have a funding fee, right? Yes. So it works a little bit differently, but they can get into their house with zero down payment. So that funding fee is added to the sales price, which is also, or to the loan amount, which is also the full sales price. Typically you're gonna have to put a little bit of down payment. So your loan amount is less than your sales price. Well, they don't have to do that, right? Their loan amount is the full sales price plus the funding fee. So they go into it with negative equity. And that's why it's not that their house lost value. It's just that the way their loan worked, they have lost
negative
value.
Equity.
They have it.
So 344,000. So there's no negative equity here, but this next one is my favorite slide.
Oh, this next one?
This wasn't my favorite slide.
Okay, ready?
Yeah, go.
Let's do it.
Look at this.
Oh!
Mortgaged homes with over 50% equity as of 2023. 38%. Can we agree that's dark green?
That's dark green. That's the darker green.
Almost 40% of homes have over 50% equity.
Beautiful.
If you get in trouble financially on a house and you can't make the payments and you're risking going into foreclosure, are you going to let that house go into foreclosure, or are you going to sell it because you've got 50% equity?
Right.
You're going to sell the house. You're not going to let it foreclose.
Exactly.
Okay. Mortgaged homes with 1 to 49% equity, 30%. Same thing. You've got equity. You're going to sell the house. You're not going to let it go into foreclosure.
You're living in your savings account, basically.
Yes.
I mean, certainly would have to move.
Yes.
But you're living in a huge savings account. Yes. That's your nest egg, right?
So those are the people that have mortgages that have plenty of equity. Okay. Then 30% of homes are owned free and clear. There's no debt. There's no mortgage. That is, what is that? That's like more than zero.
Well, it's 100 minus 2.1. Yes. It's 97.9%.
97.9%.
That's why
have equity in their homes. Only 2.1% have negative equity.
Yeah.
This is why a foreclosure tsunami is not happening. Even if the market crashes, even if all of a sudden whatever happens,
they lose their jobs, they get long-term COVID or whatever.
They sell the house. They have the equity. They sell the house. They take the cash.
And that would just mean you're looking at the inventory that's on the market, right?
Yep.
It's not a big foreclosure thing coming, and that's a big if. I mean, the unemployment rate is really, really low. We don't see that changing.
Yep.
The pandemics, I mean.
Yeah. So there's so basically our whole point on this, I think this is our last slide. Click on that.
Okay.
Yeah. So basically the whole point on this is you have to look at statistics. Go back and watch this video over and over again. Look at the graphs, look at the stats.
You'll share slides if you guys want to take it and look it over and talk to your person about it. We're big on trying to educate our kids on financial, basically on anything they'll listen to us long enough for.
Yep.
So we'll share, and the more you know, the better.
Yeah, because you just make educated decisions. And if you have questions, if you want to talk about your situation personally, let us know. We've seen so many stories. I can think of 3 or 4 off the top of my head where I've had clients that that the fear has over. It's who. The fear has overcome their action, and they've sat on the sidelines, and the houses they were looking at they can no longer afford, not just because of interest rates, but also because it's appreciated out of their price range. So just make logical decisions. Let us know what questions you have. We're going to dive into the market report for the last 7 days here, and then also get to our mortgage minute. But please let us know if you have any questions, and Kelly and I would just love to sit down with you each on an individual basis. All right. If you got value from this,
you could talk to us at the same time too.
Oh, that'd be fun. Zoom. We'll see you next week.
Bye.
Okay, so hopefully you found that information helpful, and now we're going to dive into what's happened in the Northern Virginia market over the last 7 days. And if you remember from the previous 2 market reports, we've been looking at a trend that was almost an exact mirror of what happened at this time last year, which led into a 6-week period of opportunity for buyers. So let's look at the graphs and see if that trend's continuing or if there was a change over the last 7 days. All right, so as we come in here and we start looking at our graph, you'll see that the orange line is our buyer activity, or in other words, it's our demand, and the blue line is the inventory, or that's our supply. And you can see, like we were talking about over the last couple weeks, that they were kind of lined right up with each other, which was matching right here from last year. We were sitting right here. So it looked like we might be about to dip into a little bit of a buyer's market area for about maybe 6-7 weeks like we did last year. But what happened over the past 7 days was inventory went down and buyer activity went up. So as we've seen throughout most of the year, the orange line, or the demand, just got higher than the blue line, or the inventory, or the supply. So that gap right here puts us back into that seller's market. So it looks like we are just continuing this trend where we're skating right along this upper level of seller activity. Again, on this line, the orange is a neutral market. Seller's market is anything that goes above. Buyer's market is anything that goes below. So we've been doing this now for going on a couple of months, just kind of staying and hovering right here, and it looks like we might be continuing that trend. So as we say each week, buyers, you need to be strategic. You need to make sure you have your financial affairs in order so that you can move quickly when you see your property that you like. You need to make sure that you have your team fully built out. If you don't know who your team members need to be, reach out to us. I'll be happy to discuss that with you for your situation. But you want to go ahead and be prepared to put an offer in quickly so that when you see that property, you're able to compete. Kelly and I have done many videos over different strategies to have yourself positioned in a way that you can compete with regards to terms, not only on price, and you can do that even if you have need for lending. You're not a cash buyer. So reach out to us if you need any information on that. Sellers, great time to sell. Just make sure you're pricing the property appropriately for its condition, and that you are preparing the property. If you want to get top dollar, make sure that you're preparing the property and making it desirable, because you are competing against other properties. Okay, if you have any questions, please feel free to reach out and let us know. And now we're going to get over with Tatiana and go through the Mortgage Minute. All right, everybody, we are here with Tatiana Ivlila Lopez from Prosperity Mortgage for this week's Mortgage Minute. And we're going to continue our conversation about strategies for how to handle the increased interest rates. But first, Tatiana, what's going on with the market?
Hi, everyone. So the week of September 15th to 22nd, 30 and 15-year fixed interest rates increased slightly. So for the week, the major announcement was from Fed reserves that they kept the rate the same. And, they held it steady, but also they indicated that there's still a possibility of another hike before the end of the year. So let me share the screen so I can show you this little chart right here. Can you see it?
Mm-hmm.
Yes.
Yep.
Okay, so we have a dark blue is conforming rates, and light blue are jumbo. Those are over $1.89 million in our DC metropolitan area. This purple, I guess it's purple, right? It's FHA loan. So the rates went up slightly. Last week it was around 7.18%. So we do see some increase. So looking ahead, all eyes on upcoming November 1st meeting of Federal Open Market Committee, or Feds, as we know that. Some predict that they will increase the rate. About 28.7% of forecasters predict that rate is going to increase, and 71.3% predict that rates are going to remain the same. So, but none of them expect rates to decrease.
I was going to ask you that. No one expects them to go down.
Not as of right now, no.
Okay.
Okay. So I noticed that since the rate stayed the same with him the Fed not raising the rates, but I noticed that the rates did tick up a little bit. So what's the mechanism behind how that happened?
Right, that's a good question, because a lot of buyers, they think whatever the Fed say, that's what is going to translate whenever they talk to their mortgage lender, and that's not always the case, right?
It's really not the case. It's more just because our rates, they did not really depend on federal, whatever Fed does, but whatever comments they make, what they predict for inflation to go up or to go down, that what drives the mortgage rates up or down.
Okay, because the mortgage lenders try to get ahead of what they're predicting. Is that right?
Correct, exactly.
Okay, that makes sense. We do have a regularly asked question from buyers, and I'm hoping you can go into it in some detail that maybe we can't for everyone, and it is discount points. Well, I know it's a handy tool for these higher rates that they can use to lower them a little bit, but what are they and how do they work?
Okay, so it's a very good question, and a little bit of glossary. So discount points is a charge to permanently buy the interest rate down. So you can get interest rate without paying anything for it, or if you want your rate to go down, it to be reduced, you pay points. One discount point equals 1% of the loan amount. Half a point, 0.5%, and so on.
Okay.
So I actually prepared little PowerPoint presentation so I can show you, how it translates, and interest rates and monthly payment. And what we do as mortgage consultants, we show the clients, all the options, and we show rate with points, rate without points, how much it costs, how long it takes to recuperate from the cost of it, and then they make educated decision. Does it make sense to buy or not? So let me do that. I'm gonna share my screen again, and I'm gonna do real fast.
Yes.
Like this. You can see the blank screen, right?
Blank screen, yes.
Okay, so let's just look at this scenario. 500,000 sales price, 20% down, so the loan amount is 400,000. Let's say the credit score is 740, first-time home buyer. Just right away, I'm gonna tell you the rates, they could vary slightly depending on how much person makes, and there's different things that could change the interest rate. But look, for the example, I'm giving this rate 7.375% today with 0 points. Principal and interest payment is $2,762.
Okay.
So let's say we're buying a point down. The rate is gonna go down to 7%. So 1 point, which is 1% of the loan amount, $4,000, buy the rate down by 0.375%. And principal and interest payment is $26.61. Monthly savings $101.49. Then the break-even point, we'll look at 39 months or 3 years and 3 months.
Okay.
Simple math, $4,000, the cost of the point divided by monthly savings.
Okay.
So now it's going to be a question, how long we're going to keep the property for, right?
Right.
Or is this $100 crucial in monthly savings for you to have, to pay the point? Because everybody needs to understand and know what their maximum comfortable payment is. We don't want anyone to be house poor, right? So that is important factor as well. So let's say another example, we're gonna go a little bit higher in the price.
Okay.
So let's do $1 million price range, 800,000 loan amount, the same scenario, 20% down. It's a little bit different bracket. When we go above 726, 200, the price in the loan amount, it's high balance conforming loan limit. So a little bit different rates as of today, 7.25 with 0 points. Principal and interest is 54, 57.
Okay.
Paying 1 point, $8,000. It goes down to 52.55, 200 and roughly $2 monthly savings. Break-even point, actually the same, 3 years and 3 months.
Right.
Yeah.
So that's what we look at, and that's how we analyze to see what happens. And sometimes every rates change every day, right? So sometimes 1 point can buy the rate down by even 0.5%. I've seen instances when the rate was lowered by 0.875%, and then it kind of becomes a no-brainer to buy the points.
So it's not always 1 point equals a 0.25% reduction in the rate.
No.
It can vary based on the
Exactly. It fluctuates every day.
Okay.
And sometimes, you don't need to pay the whole point. Maybe you'll pay 0.75% of a point to get to, the same reduction. So it changes, it varies.
Okay, that's very, very good to know. And I've seen some buyers when, a lot of buyers, they like to shop their loan with other loan officers. And they'll get a quote from one and then say, oh no, this one they're offering, let's say they get the 7.375 from one, and they're saying, oh no, I'm going to go with this other lender because they're offering 7%. And it's kind of like, how do you do that? But then when we urge them to get the actual loan estimate, not just the quote, but the loan estimate, and we see that the loan officer has actually factored in a discount point that they'd have to pay that they didn't discuss with the borrower. Have you seen that when people bring you loan estimates? Have you seen and then had to tell them, oh, well, that's because of a discount point, and they're surprised?
Exactly. It's a very good point, Kelly, because when you shop for a rate for a mortgage, you don't just look at the rate and bottom line, right? How much you need to bring to the settlement. You need to look at the rate and the cost of the rate. And the cost is that discount points. Also, you want to see at how much lenders charge of origination fee, or sometimes they break it down to underwriting fee and processing fee to make it look that it's less. But when you combine underwriting and processing fee, it could be a lot of money. And so that's what you look at when you're comparing one quote to another. And that's what I do when clients come to me and say that somebody else gave me better rate. I ask for the estimate, because I will see right away, are they charging points? What are their origination fees? Sometimes they charge 1% origination fee and 1% in discount points to get the rate down by 0.25%, right? So, and then I'll tell them, okay, well, I can do the same if you want. It's gonna be more expensive.
I mean, I can do that.
But that's what you need to look at.
I do think that's one of the reasons we loved working with you so much, is because the less scrupulous loan officers, it's kind of smoke and mirrors. They say, oh, I can give you that. And they don't give all the details. You know, you really have to compare apples to apples. And you've always been very straightforward with our clients and very just showing them exactly what's going on with their loan. And I think that's one of the things that everybody needs to look for in their loan officer.
And that apples to apples is the loan estimate to loan estimate, not the pre-approval quote and all these other things, because there's no lock, there's no disclosure of all of the costs until you get that loan estimate. Is that correct?
Absolutely, yeah, that's
Yeah.
correct. Yeah, thank you so much for the compliments. It's true, you know, I think transparency goes a long way. A lot of people, they don't understand, they don't buy houses every day, so
Right.
I want to educate them so they understand what they actually signing up for.
That's
Yeah.
exactly right. It's not their fault that they don't know, because it's not their world. This isn't their job.
Yep.
But yeah, so it's our job to take responsibility and show them everything. So
And I just need to throw out there that it's also important that your lender is available outside of office hours, not
Yes.
Monday through Friday, 9 to 5. Okay, that's a whole rabbit hole.
we monitor Tatiana all the time, even when she's on a boat somewhere out of the country, and she always replies.
Yeah,
24/7.
that's right. That's right. All right. Anything else for this week?
That's it for me.
Okay. How about you, Tatiana? Anything else?
That's it. I just
Okay.
want to wish everyone great weekend, and I'll see you next week.
If anybody wants to find you, what's the best way for them to reach out to you?
They can contact me at 571-245-3000.
Okay,
Very
perfect.
good.